Assets backing European private capital, they are expected to double in the next 4 years to just under $5 trillion. That's from data from Preqin. Now, a lot of that growth is going to be led by debt private markets. You know, at the same time, though, this is a sector, as we've been speaking about, that has to contend with risks from rising interest rates to those recessionary fears, of course, all which potentially could sour sentiment and spur defaults. Now, joining us is someone who's both very familiar with those risks and the growth of the industry. It's Blair Jacobson, the co-head of European credit at Ares Management, who manages over $300 billion, and of course, a pioneering force in direct lending. Blair, thanks so much for joining. So, I mean, it's a fascinating time from the industry, considering you just came off of COVID, this huge lending spree coming from you and your peers. Has it held up this year as we're staring down the possibility of a recession?
So you're right. We are facing three major concerns at the moment. We're seeing the highest levels of inflation, frankly, that many of us have seen in our professional careers. Started the end of last year. That certainly continued and been exacerbated by the war. Secondly, we are in a rising rate environment, as you've cited many times on this program. And the central banks have said it's going to continue. And lastly, what you just mentioned, certainly some fears around an economic slowdown and potential recession. From a deployment perspective, we've been consistent. We've been cautious. In fact, we're benefiting from the fact that private equity firms in Europe are still sitting on record amounts of dry powder. And the dry powder in our sector is maybe about a third of that, maybe 35%. So at least a pretty favorable supply-demand imbalance for us.
So you're still deploying capital, but are you scaling back in terms of how risky you're willing to get and how conservative you're being in deploying that capital and loaning money?
I think part of our model is we've always been highly selective. We talk to maybe 1,200 companies every year in Europe, and we make new loans to maybe between 30, 40, 50. So we're definitely looking to back the best companies we can find, and importantly, in the most defensive industries.
Blair, good morning to you. Thanks for joining us both. It's good to have you and get your take. You said you've become more cautious and more considerate, and the natural pro quo to that is, if out of 1,200 you do 40, where are you most cautious about? Where are you most worried about default risk, really?
Sure. Our portfolio naturally underweights sectors that are most default prone. You won't see a lot of consumer retail in our portfolio. You won't see energy, oil, power, gas, media advertising. We're much more focused on stable sectors that are less linked to GDP growth, sectors like telecommunications, healthcare, software, and business services.
Well, let me ask you this then, because we have heard anecdotally of others who are pulling back on lending, who are fearful, who are worried about defaults. So what are you seeing differently that's allowing you to continue to do this when others aren't?
I think it starts with a very strong capital base in Europe. Plus, we have 80 people in 6 offices looking for transactions. And again, it's really depending on which companies you're focused on, your capital base. And we've really shifted towards focusing on being senior in the capital structure. We've tightened up our loan documentation just so that we're prepared in case things do decline.
Well, is that what you're seeing, though? I mean, you're preparing for it, but are you expecting some defaults to come? Are you expecting a default wave?
Potentially. Again, right now we are obviously mindful of the macro. However, we're long-term investors. We've seen in certainly the first 6 months of this year, companies are continuing to grow. They tend to have pricing power. They've passed on the inflation that they've seen by raising prices. Will it continue? We'll see. But again, as a lender to these companies, we have a different outlook for what needs to happen compared to, say, what the equity or the key stakeholders in the business need to see happen.
But in part, that's about the capital structure, isn't it? And therein lies the point, Blair. Dani and I were chatting about this. Private credit loans are floaters. They're majority of them, we understand, are on floating rate. Are you seeing a large appetite to switch? Are you having to consider that to help weather the storm coming forward?
Yeah, that's a great observation. Clearly, as we said, we're in a rising rate environment despite the macro. And for us, it's a bit of a double-edged sword. Clearly, our returns and our investors' returns go up when the base rates increase, because roughly 90+% of our loans are indeed floaters, so that's a positive. But the question you're getting at is, at what point do the companies have challenges absorbing those base rate increases? And we've done a lot of math on this as it relates to our portfolio. And by our estimates, base rates need to rise to about 6% for it to really start pinching the companies. And the other factor, which I think you're getting at as well, is starting in January this year, most of our companies started to hedge their interest rate exposure from
Blair,
floating.
do you think there's a risk of 6% rates? Do you think there's a risk of 6% rates, as Ray Dalio says?
It could certainly happen. The forward curves wouldn't indicate that it's expected. But when I moved to the UK in 2005, the rates here were 5% going up to 6%. So yes, it could certainly happen.
I do wonder, I mean, are you hiring more restructuring experts right now in your business?
So we've always had that. As part of our 80-person team in Europe, we have 15 who are solely dedicated to helping monitor the portfolio.
So you're not then, or?
Including restructuring experts. Yeah. So yes, we have 3 senior-level restructuring experts, but really, we've always had them. The cornerstone of our strategy is capital preservation, and when you're lending to middle-sized companies like we do, things can happen, even in good environments. So playing strong defense has always been a key part of our strategy.
I mean, you are very, perhaps cautiously optimistic for Ares, but what about when you look across the industry? Because obviously a feature of COVID was this hunger for deals. People perhaps lending out and doing these covenant-light lending where they had less protections. Are you fearful for the industry as a whole at this moment?
So we did observe that trend, in particular 2021 coming into 2022. By our estimates in the European direct lending market, maybe 5% of the market went to Cov Light. And basically what that means is, as a lender, you only really have rights when the company has a liquidity issue or frankly misses an interest payment. Those aren't loans that we've participated in, and certainly I would be concerned if I had a lot of those in my portfolio going into what will be a challenging macro environment.
So you're concerned for others then that have done this?
We are.
Okay, fair enough.
Glad we didn't do them.
Blair, okay, one last squeeze on you. Who's the most desperate for funding at the moment? Let's just punch one last one out of you, because we're fascinated. Who is the most desperate at the moment at your door?
Sure. I think what we've seen is increased demand from larger companies. This is an interesting dynamic to spend a moment on. As you've probably covered, the capital markets are basically closed right now. Commercial banks are risk off. Investment banks are risk off. And that's actually created a nice dynamic for us because, again, we're a large-scale fund manager and we're more relevant to larger companies. So the average profitability of a company that we're lending to is probably up 30, 40, 50% this year than it was last year. So again, big convergence trend, lending to larger companies that frankly can't get capital today in the traditional liquid markets.
Go for size or go home. Blair, thank you very much. Blair Jacobson there, co-head of European Credit at Ares Management. We thank you for joining us.